Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. My name is David Blain, your host for the show. Thank you for joining us here in New Bern on Cable TV 10 as well as 94.1 FM WNBU. It's certainly today as I record this, yesterday was the sixth largest drop in the Dow in history, and so it'll be a couple days by the time you hear this. It'll be interesting to see what happens, but it's a pleasure to be able to sit here and talk to you after such a down day in the market. We'll get into that in a little bit. If you have any comments or questions for the show, as always, feel free to give us a call at 252-633-0107 or email us at allthingsmoney@dlblain.com. And of course, you can visit us on the web at www.dlblain.com. There you find information about myself, my company, as well as archived copies of the show. So let's get right into it. Yesterday and actually the past couple weeks have been an absolute sell-off in anything risk-based. You may have heard the term risk-on, risk-off trade, and a lot of these traders on Wall Street, that's the terminology they use, is one day is risk-on, meaning they flood into commodities, emerging markets, small caps, things like that. Risk-off days, they buy treasury bonds and go to cash and short different things. Well, definitely the past couple weeks have been risk off, and so I wanted to address that. Of course, yesterday was the first day of trading since the S&P downgrade, so I think we would start with that. First of all, I'm not surprised. In April, the S&P indicated that unless there was $4 trillion worth of cuts in the budget deal, that they would in fact cut the U.S. Treasury rating. I'm not sure that I necessarily agree with their decision to cut the rating, but in fact they telegraphed exactly what they were going to do back in April, and so there should have been no surprise to that on Friday. The budget deal or the debt deal, I'm not sure who thinks that was a good idea, but I am not sure anyone does. I guess that's what you get when you have so much compromise. You end up with something that nobody wants and isn't good for anyone. And I'm afraid that's what happened. We didn't really address the spending problems. We didn't address from the other side, no revenue enhancers or increased taxes either. And so basically, after all that fussing and fuming and everything, it turned out to be just a normal vote like the times previously where they just raised the debt ceiling. I mean, a couple $1 trillion in cuts over 10 years is nothing. In fact, they probably won't even happen based on politicians. And all they're doing is, instead of, for those, I know this is not a political show, but for those of you that may not have heard by now, government accounting is not like your household. If I said to a client that came in and said, look, hey, you're spending $25,000 a year on eating out, and I said you need to cut your dining out budget back, what do you think that person's response would be? Or not response, but thought process would be, okay, I need to cut it from $25,000. By the way, that's an exorbitant amount. I use that to illustrate the absurdity of this. Okay, I need to cut it, maybe some Hollywood person spends that. So $25,000. What do I need to cut it back to? Do I need to cut it back to 24, to 20, cut it in half, cut it down to, $5,000? That's what most people would think about when they thought about cutting spending. When it comes to the government, when they talk about cutting spending, what they mean is, well, I spent $25,000 last year and I plan to spend $30,000 next year, and so instead of that, I'll just spend $28,000. That's a $2,000 expense reduction. That's how this process works. And so if you don't understand that, it can be quite frustrating when you hear these things. But so essentially, in my opinion, and a lot of other people's, that budget thing did absolutely nothing. However, in terms of the credit rating and the U.S. being able to pay the debt on the Treasury, I really don't think that it deserved to be the rating cut. Sure, we've got budget problems. Sure, we've got entitlement problems, all sorts of issues that we need to work through. But there was really no question whether the U.S. could meet its interest obligations at this time. So anyway, now the interest rate has been cut, and I told you this last week and previous weeks. I had somebody that I was talking to. They were thinking about shorting treasuries because the debt rating would get cut. Yesterday, one of the worst days ever in the stock market, U.S. Treasury bonds, and the reason it was a bad, well, we'll get into that, but it was the day after, the first trading day after U.S. Treasuries were cut, their rating, but Treasuries went up, long-term Treasuries went up over 2% on the day. What does that mean? It means that people all around the world were flooding to the U.S. Treasury yesterday to purchase them. So they were obviously not concerned that Standard & Poor's cut the credit rating. That was not the problem. The sell-off in the market, frankly, I think that the markets got kind of distracted with the budget debate, and they stopped focusing on some of the economic problems and some of the other things that are going on. But to attribute yesterday's sell-off simply to the downgrade, I don't think is a very good representation of it, because treasuries actually went up in value. So once again, one of the things I think to learn from this is the sheer unpredictability of events in the financial markets. You watch other TV stations, maybe people, 24/7, people with all these predictions, and this is going to happen and that is going to happen. It's very unpredictable, and as I've said many times, the best approach is to understand what your goals are, understand what sort of stomach you have for risk. I mean, let's face it, it doesn't matter if some investment makes all kinds of money. If you can't sleep at night because you own it, because it periodically goes down, 10 or 15% over the course of 2 weeks, you probably shouldn't own it. And so looking at things like your goals and your allocation are much more applicable to an individual. There's just no way to predict these events. I mean, a lot of people thought, this will be the collapse of the U.S. Treasury market, the dollar will collapse, the U.S. economy will collapse. Well, none of that happened. Now, incidentally, the U.S. dollar also went up. There is a relationship between the Treasury and the dollar. When people are buying Treasuries from overseas, they also need dollars to buy those Treasuries. Well, we're coming up on our first break here. When we get back, we'll continue this discussion about the historic debt downgrade and day in the markets. So for All Things Money, I'm David Blain.